From the morning reading, Spider forms inverted hammer. Potential bull flag setups following pullback day 2. All 9 sectors moved lower on Tuesday. XLI, XLB, and XLP were the strongest sectors, while XLU was the weakest sector. Oil futures rose $1.10 to close at 36.56. Breadth weakened as decliners led advancers 2.33 to 1 on the New York Stock Exchange and 2.33 to 1 on the NASDAQ. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:20 a.m. Central Time, and I'm recording this in preparation for the market day of April the 6th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut, things were pretty quiet, up slightly, with the S&P futures up about 3 points or just above scratch. Russell futures up about 0.25%. NASDAQ up just above scratch, as is the Dow. Crude oil is up big, up about 2.87%. Euro down about 0.33%. Bonds down about 0.25%. And gold down about 0.25%. Overseas actions mixed, but mostly revolving around scratch. China just below scratch. Hong Kong just above scratch. Japan down just below scratch. Germany up more significantly, up about 0.4%. United Kingdom up about 0.5%. In terms of macroeconomic reports for today in the United States, we have crude oil inventories weekly report. We have FOMC member Meister speaking, and then the FOMC meeting minutes. So that might give us some clue as to what the thinking is going on right now. In terms of looking forward, we have the weekly version of the unemployment claims, natural gas storage weekly report. We have Fed Chair Yellen speaking, and FOMC member George speaks as well. And looking forward towards Friday, I don't see anything on the U.S. report of note. In terms of our current conditions and volatility front, short-term VIX popped up a little bit yesterday, just below 14. Skew benign. IV percentiles also benign, very, very low, with the SPX at a 17, the Russell at a 22, the NASDAQ at a 17, and the Dow at a 14. Note that we did have standard deviation down moves yesterday on 3 of the 4 indices, everybody except the Dow. In terms of our current reports, let's take a look at the S&P first. Now you see we've had a bit of this pullback, and the question, of course, is this just another bull flag and another in a long series of bull flags and a bullish continuation pattern? Or does this one, do something different? We've run up against this area of resistance. We're watching very carefully. It did undercut Friday's swing low, which was somewhat ominous, but it didn't stay there very long. The bulls came in, so right now it's just a false breakdown and recovery, and we certainly haven't had anything of a breakdown as of yet. It just kind of tickled. If we look at the Spider ETF, you can see that inverted hammer that one of the morning authors was talking about. So that price action during the day session, gave us that pattern there. In terms of the Dow, again, rollover it would seem, but yet hasn't followed through as of yet. We'll be watching to see, do we start breaking down below these former lows and set up a short-term pattern that is not just a bullish continuation pattern or not. Possible to determine quite yet. Certainly there's a number of signs you could argue either way. We've had a number of bull flags that have certainly legged up another leg, and just because you get a bit of a pullback doesn't mean that it's all over. This could be just another bull flag. But as we see the various signs here, we do start to see, there may be something more to this one yet. And then the Russell. So just because you got a down arrow doesn't mean it's over. So we had down arrows here and here, and then promptly, bulls came in and rushed back up and set a new higher high each time. So these are just normal bull flag continuation patterns until proven otherwise. Now, the fact that we're up against this area of resistance is why this is so concerning. We'll take a look at bonds, see if there's any clue there. Certainly we had a cloud breakout, GCal breakout, with bonds breaking up yesterday. Thus far, though, seem to be retracing some of that move. Volatility certainly broke up yesterday, but again, so far with the futures of the overnight, doesn't seem to be doing any kind of continuation on that yet. We did look to see yesterday with bonds and gold, being both considered flights to safety, both moving in coordination, it would seem, though gold ended up closing just below that diagonal resistance area, and so far that diagonal resistance area, though probed, has yet to give away to any kind of real breakout. So we continue to see what signs that may give us. So none of these yet are telling us that things are over for this current bull trend on the short to intermediate term. Let's go ahead and go to the daily report. Intermediate term phase opinion, phase 4 continues. Price patterns near horizontal resistance. Our 3 market timing signals. The one from IBD, confirmed uptrend, still stands. Accumulation distribution score remains B- on both the NASDAQ and the S&P. GMI index did drop a notch to a 5 out of 6, but the buy signal is still retained and has been in place since March the 2nd. Decision point scoreboard status, also no change. We still have a nice stack in the short to intermediate term, but up against the face of a long-term bear. So our consensus of our market timing signals is that we do have a bullish bias to a market that's still in transition, and that transition being this wide-ranging action. And until we get a stack of all 3 of these time frames, that transition definition will remain in place. Clearly a bias to the bull side, though, for the shorter to intermediate term time frames, and that much is in alignment. In terms of the position sizing opinions, no change here. Both still at 100%. Intermediate term market postures for the S&P and the other 3 indices, all still very strongly bullish, with a weak bullish sentiment line, a weak but improving bullish sentiment line, which means that we expect that bull legs and the trend will be longer and more pronounced than bearish legs. So until proven otherwise, that's the thought process. The strength of the trend is weak but significantly improving. Hedge warning status remains 0+, normal with some elevated risk conditions. And you see that one of those, we finally had this volatility ratio fire a signal yet, so it did close back within that threshold, if you understand that system. Bottom line to this is that when you have extremes in volatility, in this case we had a very, very low volatility, you expect that you'll have an increase in volatility, and with yesterday's action, that signal did fire. You also had an increase in the distribution day count, and the NASDAQ going back into warning status at 5, the S&P increasing to a 3, still not yet warning status. Skew down below 125, so that's gone away. In terms of new highs, new lows, didn't hit warning status at 300, but certainly much more pronounced to the bearish side yesterday. One of the things that has been persistent here of late has been this key intermarket risk aversion indicators. All 5 of those have been flagging as risk off, and those are still present. Sentiment did ebb somewhat with yesterday's action and has come down to more normal levels. So really, in terms of those warnings, really it's just this NASDAQ being on a relatively high distribution day count, these risk aversion indicators all being flagged off, and this volatility ratio warning flaring. So there's just really three warnings that would be these elevated risk conditions that are notified to us from this hedge warning status. In terms of strategy opinions, no change from yesterday. Our option income strategies, cover calls, put selling, all conditions acceptable to initiate new positions. You still have some defensiveness here, and you notice the one in the money versus every two out of the money strikes suggestion for the covered calls, the one low beta for every two high beta positions, and the distribution of your portfolio there. So a little bit of defensiveness, but much more aggressive posture in the construction of these strategies and of your portfolio than perhaps we've had for quite a number of weeks. Now, if these conditions continue to be challenged and we start to see more of these fire and we start to see a lower low and a lower high come into the patterns on the indexes, and I'm sure will become more defensive. But as of yet, there's not a cause to do that. In terms of the fear and greed index, come down a little bit, much like the other sentiment indicators. This is that composite of 7 different signals, down to a 69. In terms of the intermediate term market posture by the individual sectors or ETFs, no new signals. And you see we still have this broad cross-section of both defensive and higher beta, more aggressive areas of the market. In terms of percent change yesterday, you note a lot of neutrality came back in, especially the short to intermediate. And look at the relationship between the ones that are holding up and their beta. So telecoms holding up, beta 0.87, consumer staples 0.59, healthcare 0.71, and technology an even 1.01. So the lower beta areas, for the most part, were the ones that held up. Now, there are some exceptions. Here's utilities, also went neutral. Utilities have been on a good run and maybe just on something of a retracement and some profit taking in that pattern. But that one, of course, is very defensive, and it also went neutral. But notice that for the most part, the higher beta areas, here's energy 1.28 outright down on all 3 time frames, industrials, financials, the pretty much a rotation from high beta back to low beta with the exception of utilities. Percent change yesterday, you see utilities was the big loser of the day. Other than that, financials and then healthcare coming in behind that. Healthcare, this might be somewhat affected today as well. The Pfizer-Allergan inversion deal seems to be called into question after the Obama administration issued additional rules trying to stop such things from happening and keep those tax dollars in the United States. In terms of financials, again, it's very difficult to have a healthy bull market without the participation of the banks, and they continue, as you see up here, neutral. They continue to have some struggles, and until we have a broader cross-section, and certainly we see an improvement here at that many of these have gone intermediate-term market postures bullish. But until we see some real strength coming from some of these stalwarts of strong bull markets, it's really hard to get too excited. That being said, we've gone up something, nearly 15 percentage points from the lows, and you have to respect that. So we're in this kind of tricky place where you've gone from the 1800 up to nearly 2100, from the annual lows back into the area of the 52-week highs and all-time highs, all within a period of about 6 weeks. A remarkable move that really needs to be respected for the short and intermediate term strength that presents, and yet at the same time we've got against this backdrop of this longer term. So a lot of different things that we have to try to account for here as we make our decisions. That's the kind of problems you get when the markets aren't properly stacked and you're in this transition period. So I think that's probably enough for today. And just a note here that if you'd like to get emails, and we don't send out very many at all, I don't think I've even sent out one in the last week or so, very limited number of emails, mostly when we have a hedge risk level change or a periodic blog article. To get onto that email list, you just go to this website address right here, roll down just a little bit, you'll see this button, click the button, put your first and last name and your email address in there. That'll get you signed up to be participating in the email distribution list. Along with that, you'll get a hyperlink that gives you a copy of the ebook, the portfolio strategy that we wrote, and hopefully you'll find that of interest. If you like to do it through the smartphone, you can get the same effect. Just text Falcon Global, all one word, to the number there, 22828, and that will take care of it. And I'll just scroll through the rest of this. If you see something of interest, certainly just hit the pause button and go to the hyperlink and get additional information. Obviously, we greatly appreciate you retweeting us to your Twitter followers, to your StockTwit followers, and then also liking us on YouTube. All those things certainly make a difference for this free content that we provide to you each morning, and encouraging us to continue to do that. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and you see the hyperlink down here at the bottom for the full set of disclosures. We'll see you back here tomorrow morning with the Falcon Global Market Preview. Good trading.